Futures or options? Same view, same capital, totally different trade. Which one fits yours? Let's break it down.
Same view of the S&P 500, same 30 days, same $10,000 of capital. Two completely different instruments, futures and options. And the answer to which one should I trade is not which is riskier. That's the wrong question. The real one is about payoff shape, capital, and tax. By the end of this, you'll know which one fits your view and why picking the wrong one can cost you, even when you're right about direction. Start with futures. A futures contract obligates you to take delivery of an asset at a set price on a set date. In practice, you'll never see a barrel of crude. Almost every retail futures trade is cash settled or closed before expiry. Here's the mechanic. You buy one E-mini S&P 500 future at 5,200. Contract size is $50 times the index. Notional value, $260,000. Initial margin, around $13,000 to $15,000. That's it. You're controlling a $250,000 position with 15 grand. The leverage is structural. But here's what most beginners miss. Futures are marked to market every single day. Index rises 10 points, $50 a point. Your account gets credited 500 overnight. Falls 30 points, your account gets debited 1,500 overnight. Not at expiry, overnight. And if that loss eats into your margin, you get a margin call inside 24 hours. The exchange does not care that you plan to hold through the drawdown. That's the trap. Daily mark to market means every tick is real money, and the exchange's clock runs the trade, not yours. Now options, completely different shape. You buy one SPY call with a strike of 520 expiring in 30 days. Premium quoted at $5 a share. Contract is 100 shares. You pay $500. That's the most you can lose. Full stop. If SPY climbs to 530 at expiry, the option's worth $10 a share. $1,000, 500 profit. If SPY sits at 515 or below, the option dies worthless. 500 gone. The payoff is bent. That's the whole game. A long future plots as a straight diagonal, up and down equally, forever. A long call is flat at minus the premium until the strike, then climbs 1 for 1. That bend at the strike is everything. It's why the buyer's loss is capped. It's why the seller's loss isn't. But options have three things futures don't. A strike, where the payoff bends. An expiry, after which it's worthless. And implied volatility, which sets the premium before you've even bought it. Master one, you'll lose money on the other two. Direction alone is rarely enough. Here's the part nobody warns beginners about. Theta, time decay. Every single day that passes, your long option loses a little value, even if the underlying doesn't move. Even if you're eventually right, theta accelerates in the final 2 weeks before expiry. Buying short-dated options is a race against the clock. A futures position has no clock. A tick is a tick. An option is a wasting asset from the second you buy it. Now let's talk capital. Same view, moderately bullish S&P 500, same 10 grand in the account. Path 1, one micro-emini future, the MES. Notional 26,000. Margin around $1,500. Index moves up 2% in 30 days, you make 520. Drops 2%, you lose 520. Drops 5%, loud move, not crisis, you lose 1,300. Manageable. Path 2, one SPY 520 call, 30 days out, premium $5. Total cost $500. SPY climbs 2% to 530. At expiry, the call's worth 11 a share, 1,100 profit. But mid-trade, theta might have already chewed it down to 7. SPY sits flat at 520, option dies, minus 500. SPY drops, still minus 500. Capped. Two completely different rides. The futures path gives you linear exposure with no time decay. Up to, make 520. Down to, lose 520. Symmetrical. The options path gives you defined risk. You can never lose more than the premium, but you're paying for that protection in theta every single day. And here's the part most people miss. You can be exactly right about direction and still lose on the option because the move came in the wrong time frame. With futures, you can't be right but late. Every tick prints. Costs. Both look cheap on the surface. Futures commissions run 25 cents to $1.50 per side at brokers like Tradovate and NinjaTrader. Options commissions are 50 cents to $1 per contract. Bid-ask on the big contracts, ES, SPY near the money strikes, is razor thin. But options carry a second cost beyond commission. Theta. Every day on the clock is money out of your position, whether you trade or not. Futures don't have that. Options do. Build it into your math. Then there's tax, US specifically. This is where it gets very real for active traders. Regulated futures, ES, crude, gold, treasuries, fall under Section 1256, 60-40 mark-to-market, 60% treated as long-term capital gains, 40% short-term, regardless of holding period. Top bracket blended rate, roughly 26.8% federal. Broad-based index options, SPX, NDX, RUT, VIX, get the same treatment. But equity options, SPY, AAPL, TSLA, those get normal cap gains treatment by holding period. Held under a year, you pay ordinary income. Two traders, identical P&L, very different tax bill in April. So when does each one actually win? Pick futures if you want pure linear exposure to a major asset. Index, treasury, commodity, currency. If you can support the margin and you're not going to panic at an overnight gap. If you value 1256 tax treatment. If you're running a systematic strategy that needs clean P&L modeling. And if you want 23-hour market access with the tightest spreads in the retail world. Pick options if you want defined risk exposure. You sleep better knowing the premium is your maximum loss. If you want to generate income from selling volatility through credit spreads or iron condors. If your view is specifically about volatility, not just direction. If your account is too small to meet futures margin, even on the micros. Or if you're playing a binary event, earnings, an FDA decision, where the move is timing known. Remember that 30-day comparison from the start? Same view, same capital, same window. The futures trade prints every tick in either direction. The options trade caps your downside, but bills you in theta every day you're wrong about timing. Neither one is safer. They answer different questions. Futures answer how to express a clean directional view with leverage. Options answer how to shape your payoff around a specific scenario. The honest verdict? Most serious traders end up using both. Futures for core directional positioning, linear, leveraged, tax-efficient exposure to indexes and commodities. Options for event-driven plays and volatility expressions where you actually want that bend in the payoff. They're not substitutes, they're complements. The question isn't which one to learn, it's which one fits the trade sitting in front of you right now.
Futures for direction, options for defined risk. Check the description for the full breakdown.